everybody. I'm Janine Firpo, and I'd like to welcome you to this, our 11th of 12 Fireside Chats prior to the release of my book, Activate Your Money, Invest to Grow Your Wealth and Build a Better World. Today, we're going to be talking about Chapter 13, which focuses on our retirement accounts. And I would imagine most people are familiar with IRAs, traditional IRAs, Roths, 401ks, those types of things. And while we go into them in the book, today we're going to be talking about a couple of types of retirement accounts that you may not be as familiar with. One is called the self-directed IRA, or SDIRA for short, and the other is a solo 401k. And today as guests, I have two people, one who is an expert in these types of retirement accounts, and his name is Michael Shuman, and he is the director of the Local Economy Projects. He is also an adjunct professor at Bard College, and he's a fellow at Cutting Edge Capital. So he obviously wears a lot of hats, and we will be hearing about that a little bit later. My other guest is Laura Oldaine, who is the founder and president of Rich and Resilient Living, which is a blog site, and she does a lot of work in the FIRE movement, which is Financially Independent Retire Early. And she is actually a practitioner. So she has her own SDIRA, and she uses it to make investments in a lot of really interesting ways. In addition to that, I just learned today that Laura is also a socially conscious wealth coach, and we may learn a little bit more about that and what she's doing in our conversation. So I'd like to welcome both Michael and Laura to today's chat. Hi, both of you.
Hello.
Great to be here.
Great. Well, Michael, I'd love to start with you because in addition to knowing a lot about these investment vehicles, you're also a huge advocate of local investing, which I think is really interesting and which is something people might want to do with these types of accounts. So could you tell us a little bit about yourself? I know you've written a couple of books on these subjects, so you might want to touch on that. And just let us know sort of what you do, who you are and what you do, and why this area is so interesting to you.
Sure. So I guess for the last 30 years or so of my life, I have been trying to promote local economic development because I think there is a lot of data that show that the more you have a strong network and diverse network of local businesses in your community, the stronger your job growth, the stronger the movement towards social equality, the more entrepreneurship, the better public health, the better political participation. There's really a long, long list of benefits coming from a whole healthy local business economy. But there's a big gap, and that gap is capital. And it was about 10 years ago that really I came to appreciate that even though Americans have a lot of wealth in their retirement funds, at this point it's about $56 trillion in stocks, bonds, mutual funds, pension funds, and insurance funds, almost all of that money is being invested in the tiny part of the national economy that is global corporations. 60 to 80% of our economy is locally owned business, and yet we are all systematically over-investing in Fortune 500 companies and under-investing in the businesses that are critical for our well-being. And I think we've gone through this very challenging COVID pandemic. I think many of us have come to appreciate the local businesses we depended on. Many have come out of the pandemic weakened, and we need to figure out how to strengthen them. And local investment is really a critically important tool. So my most recent book, which is Put Your Money Where Your Life Is really all about how to use the self-directed IRA and the solo 401k in order to invest not just in local business, but in people and projects and real estate and other things that are in your community. And, I think the bottom line, which we'll talk about, is that it is not very difficult. It is not very expensive, but it does require some work. And if you do it, it opens up all kinds of interesting local investment opportunities. And here's the thing that I want people to think about, which is if you have two investment opportunities that are otherwise identical, same risk, same return, one local, one not, you should always favor the local investment, because with the local investment, you get a social rate of return on top of your private rate of return. That is, that thriving local business contributes to your tax base, which in turn contributes to your schools and your police and other social services. And so it comes back to you in these other ways. We don't know quite how to put a number on it, but it's not zero. And I think with local investing, if we could move, all of us move, 1, 2, 3% of our portfolios into local business, it would be the most significant economic development stimulus we have ever had.
So I really agree with you around local business, and it's fun. I've invested in some local businesses and it's fun. It is often private investing, which some people consider higher risk. But we have been, people who are not accredited investors have traditionally been left out of investing in local businesses or private businesses. That changed, and now there are crowdfunding opportunities and other ways that we can invest that way, even if we're non-accredited. The challenge is that our retirement funds are often very restricted in terms of what we can invest those retirement funds in, because we often we're either in retirement funds through an employer regulated 401k or some other type of employer regulated account. We often have a limited number of choices from which we can choose to invest in, and those are often not only not local, but they're not even values aligned. Oftentimes the 401ks that we have with large brokerage firms also restrict us to some degree in what we can invest in. So while retirement accounts are great, there are restrictions on them. And my understanding is that these special kinds that we're talking about today, the SDIRAs and the solo 401ks, are not restricted in the same way. So could you explain a little bit about what they are and how they work and the opportunities that they provide?
Yeah, and just to so we're going to talk just about two kinds of self-directed instruments. There are more, but just to simplify a little bit, so probably the people listening to this have their retirement funds in one of two kinds of funds: a IRA, which any individual can set up, and you can put something like $5,500 to $6,500 per year of your income, and it is untaxed until you pull it out after retirement age. The other instrument is the solo 401k, which is available for self-employed people. And under some circumstances, you can put away as much as $120,000 per year in a solo 401k. So say you're an artist and 5 years of starvation, and 1 year you have like this amazing hit and money comes rolling in. Well, you could put that in your solo 401k and hide it from the tax man, and you've got a good retirement nest egg. And then with a self-directed IRA or a solo 401k, you have greatly expanded investment options. So with a self-directed IRA, you have to hire a custodian from a designated trust company. And if you shop around, you can find someone, for as little as, say, $250 a year. If you want to do a self-directed IRA, you have to rent a trust document from a designated provider. And these are documents that have been approved by the IRS. And usually they're good for about 6 years. And again, if you shop around, that price could be as low as $300 for the 6 years. So it's worth talking about why the solo 401k is a better option, because with the solo 401k, you can create your own account in your own bank and then manage that account yourself rather than working through a custodian. So it's a lot easier in principle. Now, there are some basic rules you have to follow, whether it is a self-directed IRA or a solo 401k. And broadly speaking, there are 3 kinds of restrictions. One is you can't invest in yourself or blood relatives. Second one is that there's certain categories of investment that are just off limits, like S corporations or collectibles that are hard to value. And number 3, you have to be very mindful of self-dealing, okay? So what self-dealing means is that even if you're not investing in yourself, if there is some connection that benefits you. So say, for example, my retirement account has a rental unit, and the money that comes into that rental unit goes into my retirement account. Well, that's pretty straightforward, and that's fine. But if I stay in that rental unit between rentals, even if I pay my account the rent equivalent, that is benefiting me personally, and that is regarded as an illegal act of self-dealing. So you have to be careful about these 3 things, and there's a lot of details in each of these areas. But one final thing, there's kind of a get out of jail free card that you have with the solo 401k. And that is, with the solo 401k, you can take out a loan, which is the lesser of either $50,000 or half your account. So what that means is that even though it benefits yourself, you could take out a 5-year loan from your account, pay off credit cards, or put it into a down payment for your home or your kid's home, or pay off your kid's student loan. And then as long as you pay your account back over 5 years at a low interest rate, you're home free. So when you put all those rules together, there's just a huge universe of local investment opportunities that are possible. So, to summarize, you could, in some ways with a solo 401k, do an investment in getting out of credit card debt, in your home, and paying off your mortgage faster, in energy efficiency equipment, in a greenhouse. You can put money in a nonprofit you love, a co-op, a small business, in local real estate, in some form of local investment fund if it exists, in municipal bonds, or at the end of the day, if you can't find anything, just put it in your local bank or credit union. You won't get a lot of return from that, but it's something.
Well, when you talked about real estate, that was kind of amazing, because it's obvious that you can invest with your retirement funds in a huge range of things, which is absolutely not possible with most of our retirement funds. I mean, this goes beyond what most of us have ever even conceptualized as possible. And I know that these are really an underutilized tool. In fact, I think I remember reading somewhere that only about 4% of retirement assets are invested this way. So I'm really interested, Laura, you use these tools. What do you have? Do you have an SDIRA? Do you have a solo 401k? And how in the heck did you learn about this to begin with? I'm just really curious about that. And also, Michael is making it sound a little challenging. So was this hard? Could you just tell us about your experience?
Sure. I had never heard of them. I had gotten to a point where I had employer-based retirement accounts, and I was not pleased with the investing options that were available to me. And I happened to be in San Francisco, and I went to a slow money meeting. And that was the first time I ever heard anyone even mention a self-directed retirement account. And that was the way that the members of that slow money chapter were able to have money to invest in their local food shed, which was of great interest to me. And so that spurred me. I don't have anyone in my own life that has a self-directed retirement account, and I didn't stay in San Francisco to continue to tap the knowledge of the people in that slow money chapter, but I did, begin to use YouTube and Google and the library to find the resources I could on self-directed retirement accounts. And what I learned about in that slow money meeting was the self-directed IRA. If the solo 401k was mentioned then, it went over my head. I didn't catch that. And I regret that now, because I have opened a self-directed IRA, but if I were to do it again, I would go with the solo 401k for many of the reasons that Michael just outlined. But not to say that, for some people, if they're not self-employed, a solo 401k isn't going to be an option, and the self-directed IRA may be their only option. And so I ended up settling back here in St. Petersburg, Florida. And it turns out that there is a custodian company that is headquartered in my area. And part of my intention with this money is to support my local economy. So after discovering that this custodian, it's a smallish company, but it has good customer service reviews. A lot of these custodian companies, they realize that people don't even know these products exist, let alone how to navigate them and use them. So there are lots of educational resources. They make all kinds of, webinars and videos available on YouTube and on their websites about what these types of accounts are, how you use them. And they often have in-person classes. So this was pre-pandemic, I went to some of the informational sessions on site, their luncheon programs that they had. And so I just learned, I've always been one to land on my feet, not do as much research as others would do. And I just dove into it, not knowing what I didn't know. And I don't have any huge regrets. Like I said, if I could do it again, I'd probably do the solo 401k, but I'm making this work, and it certainly feels better than having my money in the other options available through conventional retirement accounts. So yeah, I just started looking like that, teaching myself, and then going down that rabbit hole and taking the leap.
So were you, this is pretty unknown, and you were putting retirement assets at risk when you made this shift. Were you nervous at all? Did you think, oh my God, I could do this and I might lose all my money? Did you have concerns or fears as you were going into this?
Somewhat, a little bit in the back of my mind, because there are a lot of legalities around this, the prohibited transactions that Michael talked about, things like that. But they're somewhat easy to avoid. If I don't make any investments in my family or myself, then I'm not, likely to hit that. But of course, that's always in the back of my mind. Again, I was more nervous about the destruction and harm that my investments were doing in the conventional mainstream options than I was about ending up, with losing the funds, which doesn't seem likely that I would lose all of it. Maybe I'll lose some returns on my investments, but I also am very intentional, because I'm not, I don't pour over financial documents and the due diligence. For me, it's about making many small investments, and that's how I mitigate my risk, is making those small investments. So I was just eager and excited more than nervous.
Great. Well, I know you are really excited about this, and it's part of what you blog about. You actually blog about your own personal finance journey. But why don't you tell us a little bit about what have you invested in? So what are some of the things, what are some of those small investments that you made? And why did you choose the things that you chose? Or how,
Okay.
and how did you find them?
So the very first investment that I made once I opened this account were through crowdfunding. That was kind of, I think, to the extent that some of these types of investments are well known, crowdfunding is probably the most well known. In a more mainstream audience, people have usually heard about crowdfunding. And so I went on the WeFunder platform and I looked for some opportunities there that felt like they were in line with my values. And I found the Native American Natural Food Products Company, which felt like a great way to put some money in the indigenous economy. I found a Chicago neighborhood revitalization project that was seeking a loan. So that, was definitely in line with my values. There was a company that was then called Scrap Connection that I believe is called Trade Fox. And they're trying to, come up with better systems for all the scrap material. So I just looked at what was on there and what felt like it was part of the solution instead of part of the problem. And that was a really easy way to do it. Those crowdfunding platforms are set up to be pretty easy to navigate. And then, with the local investing, I was letting people know about my interest in it, having conversations with people in my community. And for me, sustainable agriculture is a big part of what I want to support. And it turns out that a good friend and one of our leaders in sustainable farming had just entered into a project to take over 10 acres about an hour from my house and turn it into a regenerative farm, and was selling ownership shares. So my boyfriend and I went in together and bought an ownership share of this farm. And so, it just went from there. And I do a lot of research online. Initially I was looking at the Locavesting website, which is no longer being added to, but is still, available on the internet. And there were lots of good articles that Amy Cortez had pulled together, with things she'd learned, investing opportunities she'd learned about. And I just kind of followed, who was going to the SOCAP conference, where were the places that people were meeting to talk about community capital and what was available, what were the options they were talking about. And one thing led to the other.
That's great. So have you gotten far enough along on any of your investments to see return? And are you willing to talk about that if you have? What kind of return you're seeing on some of these investments?
Sure. So the crowdfunding investments that I made that were equity investments, no. I mean, those are things you enter into and you don't expect anything for at least 5 to 7 years, I think, generally. And I only made these investments probably 3 or 4 years ago. But that first round of WeFunder investments, I made 4 investments, and one was that Chicago neighborhood revitalization project, which was a loan, and they have annually paid back, paid their interest. And any investment I've made that is a loan has continued to pay, the interest on a regular basis. And even I only have one investment right now in the stock market, in TerraCycle. And so I do get dividends from that. So any investment I've made where I would hope and expect for some kind of regular dividend or interest payment, I have received.
That's good to know. That's good to know. And Michael, do you actually use these kinds of accounts yourself?
Well, as I talk about in the book, depending on where you are in your own financial life will determine what kinds of investments you make. Where I am until quite recently in my life was someone who had gone through an expensive divorce and job loss at the last financial crisis. And so I really have focused on paying down debt. And have almost completed that. And to me, that is the highest and most important form of local investment, because I'm getting rid of spending interest on credit card companies and other non-local financial institutions. And there's a huge rate of return. Like the avoided interest in a credit card is 20 to 25% per year. That said, over the last year, I got remarried, and my spouse has become, who is the beneficiary of a government pension fund that's quite generous. She has become a stalwart local investor. She has set up both a self-directed IRA and a solo 401k, and has been happily reviewing local businesses and may in fact create a business within her self-directed IRA in order to set up a mobile coffee cart that helps people with developmental disabilities get early jobs. And so it just, it's like this wonderful sandbox of possibilities that has given us. And it's, yeah, there are risks out there when you do it, but there's risks in the stock market. And one thing I wanted to circle back to, Janine, that you mentioned that you're excited about real estate. Well, I think it's fair to say that in the investment crowdfunding arena, there has been a pretty clear shift from investment in business to investment in real estate, because people see that it's unlikely with a real estate investment, it's not swampland in Florida. It's, that you may lose a little bit, but you're not going to lose everything. Whereas with a business, especially a startup business, yeah, you could lose everything. And recently, the SEC, Securities and Exchange Commission, changed the ceiling on what a company or a project can raise with investment crowdfunding. It used to be a little over $1 million. Now it's 5 million. And I think one practical implication of that is that a lot more real estate developers are going to use investment crowdfunding for affordable housing and neighborhood shopping centers and downtown redevelopment and so forth. So I think these kinds of options are really going to multiply.
It's really interesting that you say that. I mean, I am looking more, in fact, much of this year is going to be dedicated to looking more at the real estate market and how can you do socially responsible things within that market, whether you're talking about land or agriculture or residential or commercial. I know of some things, but I'm going to be looking at more. But I also think another thing that you mentioned about the potential risk in private investing, I think that's true. And for that reason, I think it's wise to only put a fraction of your total assets into private investing. And then I think the other thing you do to mitigate risk is what Laura was talking about earlier, which is diversify, right? And so try to put your money into a lot of businesses. I also think doing your homework and your due diligence is extremely important. And not only do I believe that personally, I've seen myself make mistakes when I didn't do my due diligence and I lost my money, as opposed to having a higher rate of success when I did my due diligence. But there's actually data out there that suggests that when you do due diligence, your success rate is higher. So that is an important component, I think, of the investing strategy. But one of the things you also talked about when you referenced your wife and her pension fund. So a question for you is it possible, if somebody is interested in this kind of investing, is it possible to take money that's in a traditional IRA or a Roth IRA or some other retirement account that you have and move it into a self-directed IRA or a solo 401k, or do you have to start all over again with a new account?
Yes. So for IRAs, generally, it is pretty easy to move your IRA into a self-directed IRA. And if you've got, money in a Roth, you can create a Roth-oriented self-directed vehicle. For a 401k, which is assigned to your workplace, it depends on the rules of your workplace. Most employers won't let you touch that money until you are fired, retired, or quit. But then you may have at least the ability to roll over that money from the vanilla flavored 401k into, say, a solo 401k. My wife recently retired from the State Department, so then all of her pension funds have become fair game for potential movement into self-directed vehicles.
Great. So for employer-based, it has to wait until you can roll over, but the other types of accounts that you have, you could do at any time. That's good to know.
And I should mention that one of the reforms that I'm advocating these days is, the law that governs these retirement accounts is called ERISA. It was passed in the 1970s, and I think there should be a new provision of ERISA that allows any employee with 401k savings to move at least some of it into a self-directed vehicle at any time. And if we could do that, it's spring. And it is spring.
It is. It's sort of shocking to me, actually, how restrictive some of these employer regulated accounts are. In fact, I just ran into it myself recently because I left an employer 3.5 years ago. And one of the types of accounts I had, I was forced to start taking out, even though I'm not of that age, I was still forced to start taking out money. And I had to identify within a couple months of my leaving the job how much I wanted over what period of time. And we're now in a situation where my former employer is shifting the custodian for those retirement accounts to another company. And I just wanted to pull the rest of my money out. I mean, we're talking about 4 digits at this point. There's only like 4-digit money left in this account. And I was like, just let me pull the rest of it out this year. And they won't let me. They won't let me. I mean, we're talking less than $10,000 and they won't let me do it. So it's kind of ridiculous at one level how restrictive some of these things are. And so it's just interesting. And I hope, and I do think we're starting to see some changes in terms of the SEC rules, the ERISA rules, some of the other rules governing these things becoming a little bit less restrictive and giving individuals more ability to invest the way they want. And we mentioned earlier the difference between accredited and non-accredited. We've defined that before in these talks, but just to repeat, so an accredited investor is someone who either makes $200,000 a year as an individual or $300,000 a year as a couple, and has done that for a couple of years consistently, or someone who has $1 million in net worth excluding their primary residence. So that's what it means to be accredited. You're non-accredited if you don't meet one or the other of those criteria. Now, I really see the benefit to people who are not accredited investors and who have more limited abilities to invest in private and local and all the things we've been talking about to really benefit from this type of retirement account. But I would think this is a great retirement account for people who are accredited too, because accredited investors also have money in retirement accounts and they're facing the kinds of restrictions we're talking about. So Michael and Laura, I'm curious about your thoughts on that. Do you see this as a vehicle that's better for non-accredited, or do you see this as a vehicle that could really fit the needs of both non-accredited and accredited investors?
I will say I'm a non-accredited investor, although I believe I've heard that the most well-known, wealthiest person that uses one of these accounts is Mitt Romney. So I think they can work for both, accredited and non-accredited.
I love that you have that reference, that Mitt Romney uses an SDIRA or a solo 401k. That's really interesting. And Michael, do you have anything to add to that, or would you agree with Laura?
Yeah, I would agree. I think what I've observed anecdotally is that that there is a difference in how accredited and non-accredited people approach investment crowdfunding. My friend Gilbert Rochkust is in Australia, and he tells me stories about what's going on with Australian crowdfunding. And the first Australian crowdfunding issue came from a company called Food Connect, which is the largest CSA in Australia. And they were raising about $1 million in investment capital to buy a warehouse for their food. A couple of interesting things. They had several hundred investors. 95% of them were women. That was one interesting thing. The second interesting thing was they said they spent nearly all of their time dealing with questions from the accredited investors who were interested. Well, is it really a 5% rate of return? And couldn't it be 6? Or, doing the due diligence. Whereas most of the non-accredited investors, and Australia has a very similar legal framework on accredited as we do, most of the non-accredited investors just treated it as, something, it's better than a donation. I'd like to see my money back, but I'm not going to quibble over the rate of return. And I think that is a difference. I think that is a difference. So as long as the marketplace right now on a lot of local investments is immature, I think accredited investors will be reluctant to get involved in it. But I think non-accredited investors actually will be very enthusiastic to do it up to some point.
Interesting. Well, I'm hoping that by educating women in general around how to be smart, confident investors and educating them about some of these types of alternatives that they may not be familiar with, will maybe move some of those accredited women to this too. And I've got to tell you, going into the whole process of writing this book, I felt like I was relatively educated in terms of investing. I'm not an expert. I don't claim to be an expert, and everything that I talk about and do is for educational purposes only, and I'm not recommending anything. But I'd been investing for 30 years. And what I learned in doing this book is there was a ton that I did not know. And that means there's a ton that other people who are less familiar with investing than I don't know, right? And so I'm really hoping through everything I'm doing, the book and so on, is just to open people's minds to a new set of possibilities. And I think this conversation today has really been a great example of that, in really helping people know that there is another way to invest, and even with their retirement accounts, which I think is really, it's really exciting. And it's something that I'm going to look into when I have a little more time with some of my own retirement accounts. But we've talked a lot about local investing. We've talked about some of the kinds of things that you can invest in with these dollars. And Laura, you talked about the crowdfunding sites that you use. But if people were interested in this, if they want to know more about local investing, if they want to know more about SDIRAs and solo 401ks, where can they go to learn?
I'd say Michael's book. Michael, do you have your latest book there to hold up, please? So yes.
So read this alongside Janine's book and flip back and forth between the two.
Oh yes, that's a great combination. But I really appreciate Michael's book for being approachable and digestible and far reduced on the legalese. I mean, obviously we need the legalities, but sometimes it's so technical and unclear. when lawyers are really focused on the legalese, right? So I appreciate that book. I have purchased 10 copies of that book to distribute to key civic leaders and government people in my community, and I'll be delivering them next week to start getting the conversation going. People in the Economic Development Office, the Chamber of Commerce here, the Black Investment Corporation here in Tampa Bay, Florida. And so I think, just getting the conversation going, I let people know in my community that this is of interest to me, and that's led to 2 of my investments. We probably are friends with like-minded people who may also want to be supporting their local community. Those are a couple of my suggestions.
Well, and I love that you're doing that, Laura. I love that you're actually buying his book and giving it away to people who you think will be influenced by it. I think that's fantastic. And, part of what I try to do with Activate Your Money is really speak to every single asset class that people have, get them introduced to that concept. Different people are going to resonate with different asset classes. Some are going to just want to know more about the stock market and are just going to want to figure out, how do I invest in the stock market in a way that's meaningful to me? So they can dig into that chapter and then go to all of the additional resources that we offer for that, right? Some people are going to really be interested in this topic. And in the book and on the website that is a companion to the book, we point people to resources that they can access. And Michael's book is there, and a book called Local Vesting is there, which we referenced earlier. Although I think it was published 10 years ago, some of the information in it is still very relevant in terms of how you go about this and how you think about it. And then I think as well, just looking in your local community and looking for people, we talk about the slow money movement in the book, looking in your local community for people who are interested in this. There is an opportunity to come together in a group. Even I know people who have pooled their assets together so that they can invest together in some of these kinds of deals that we're talking about here. So I think there's lots of ways to access this information, and we try to point to that in the book. So I will just ask if either of you have any last thoughts to share before we wrap up this session.
The 2 other references that I would offer is Laura and I and about 200 other people are part of a community called The Next Egg. And at thenextegg.org, a lot of people are rolling up their sleeves and just, asking the hard questions about how to implement the investment of their retirement of funds locally. And the other thing I'd mention is that on my own website at michaelhschuman.com, you'll find workshops that I've started doing around the country for communities of local investors. So I just finished doing 4 weeks of a course for a group of 60 people in New Hampshire, and another one for 30 adults in Washington State. And I just think there's a lot of education we need to do about many, many different aspects. And that's why the more books, the better. I think we need a lot of them out there right now. But a lot of it is just getting people to roll up their sleeves and start doing it. At the end of the day, local investment is about relationship building and just having conversations with your local businesses could be the beginning of something beautiful.
It's a great point. And I think just doing it is a great theme. It's a huge piece of what I'm about. It's like move from knowledge to action. And one way to get into that action and not be nervous, if you're the more risk averse type, is to just start with little experiments. Start with small bits of money that you are willing to lose and learn. And you learn and you get smarter and you get better and it gets more fun and you start to invest more and it gets more fun and you meet more people. I mean, I'm really thinking about personally upping the ante in my own investing in this kind of stuff because I'm gaining more confidence in it personally. But I want to thank you both so much for joining me. You both are wealths of information, and I appreciate the contributions you made to the book. Laura added some content, as did you, Michael. I really appreciate that. I could not have written this book without all of you. I really do see it as an outcome of a community. So thank you both for being part of that and for part of the conversation today.
Pleasure doing it. Yeah.
Exactly.
Great. Well, with that, we will conclude today's session. I thank you all for listening to this, and I ask you to join us next week for the final session in our Fireside Chat series, when I will be talking with Ellen Remmer, who is running something called Invest for Better. And she actually has been helping women come together in investment clubs. And going forward, her clubs are going to be using the content from the Activate Your Money book and our website and curriculum. So I'm really excited about that. But also, I'm really excited about the idea of women coming together in clubs, because I think it's a great way for us to learn. I think we enjoy it. And I have personally been in 3 investment clubs in my own life, and I have learned significantly every single time. So I think you'll learn a lot from Ellen, and you might be inspired to think about how you could either find a club or go out and start your own. So thanks again for listening, and we'll see you next week.